John,
Merryn.
how'd you enjoy that King's speech? There were no tax cuts in it, so I figured it might not have been for you.
It's true. I had my popcorn ready, but all I was doing was throwing it at the screen.
Oh, John, it's all a bit disappointing, wasn't it? I tell you who was really disappointed. The leasehold lobbyists. You know, there's been this big palaver, and quite rightly, about the way that the UK still has this absurdly feudal type of property ownership, whereby instead of buying your house and then actually owning your house, you think you buy your house, but instead of actually owning it, all you have is a very, very long tenancy. So you get a leasehold, and then you have the right to occupy the house for maybe 99 years, maybe 125 years if you're really, really lucky, 999 years, but you don't actually own it. The building and the land belongs to somebody else. Nuts.
This always baffled me, because obviously coming from Scotland, that's not the system up there.
Everything's better in Scotland.
Well, morally superior, yes. But it was weird kind of coming down, and then, I mean, thankfully, by the time I ended up buying a property down here, there was the share of freehold thing, and our first flat in Kent was a share of freehold, one in a tower block, and that was absolutely fine because it was basically the same as when we had a tenement in Glasgow. It was a similar kind of arrangement. You all own your bit and you all chip in for the running costs. So the leasehold things always seemed so just ridiculous, and also nowhere else in the world has it, I don't think.
No, I mean, it's sort of hangover of a feudal system, right? But it's really unpleasant for people who think that they actually own their house or their flat. It's actually many more flats are leasehold than houses. Although actually, you know, there are 5 million plus homes, should I say, in the UK that are leasehold, to 20% of the housing stock, and 30% of those are houses. So people think they own a house, but they don't own a house. And then you get stuck with all these things. You're at the mercy of someone else when it comes to service charges. And you know, one of the things I noticed. One of the things in the King's speech about making things less horrible for leaseholders is that the freeholder or managing agent, assuming this all goes through, when they manage the building insurance, they're not allowed to take a commission.
Yeah.
Who knew they could take a commission in the first place?
Just incredible.
I know. And then there's ground rent, and obviously people have been talking about ground rent for a while now, because during the very low interest rate period, the housing developers found there's an absolutely amazing way to create a stream of income. So you make new houses, build new houses, horrible new houses in the main, or horrible new flats, whatever, and then you make them leasehold, then you attach a ground rent to them, and you say that ground rent is going to escalate, it's going to double every 10 years, or whatever it is, or it's going to go up with CPI or RPI, etc. And then the very low interest rate environment, that stream of cash is incredibly valuable. So you flog it on to an investor somewhere. And then when the leaseholder suddenly wakes up and goes, oh my God, this cost is outrageous. And what do you mean I don't own the land, et cetera, et cetera? They have to go and negotiate with some random investor rather than with the house builder who sold them the house. So the whole thing's an absolute scandal and has been for years. So there is provision in the King's speech to try and improve it, but extraordinarily not to get rid of it, just to improve it.
Yeah, I mean, I'm assuming that the issue, because obviously this has been going on for a while, and they have stopped houses from being built with leasehold, haven't they? Because that was a massive scandal a few years ago.
Not yet. That's in there. That's in the King's speech. That they will prevent houses from being sold leasehold. And last year, I think about 1% of new built houses were sold leasehold. At the peak in 2016, 2017, something like that, it was well over 10%. So it's come down, but it's not possible.
Yeah, it's one of those things where
I've shocked you. I've made you speechless again. It doesn't happen very often.
It's just enraging. I mean, especially the house thing. The house. I mean, people generally have been aware that flats can be leasehold, and there's an element there where I guess, you know, a lot of people think that a flat isn't going to be their, you know, place for life and all of that sort of stuff. But I do seem to remember that, you know, houses generally were not sold leasehold, and obviously there's something about a house that's different because, well, basically a house is a self-contained unit. So you're kind of like, how on earth can it be the case that I only own the house for, you know, and in these cases it was 125 years rather than the 999 year lease. I mean, somebody should have, you know, I mean, it comes back to this thing where you've got more consumer rights if you buy a telly than you do when you buy a house. It's absolutely unbelievably wrong. But, beyond
and
that.
We're not long now, and we're going to be in a situation where a ordinary tenant has more rights than a leaseholder.
Yeah, that's a good point.
If you look at the other stuff that was in the King's speech about the rental reform bill, etc., says that, landlords aren't going to be able to refuse families, aren't going to be able to refuse pets, etc., etc. But I was reading a Which magazine report on leasehold from a few years ago, which said that sometimes there's a clause in the lease, your long lease, that you think in the house that you think you own, that says that you can't have a pet. And they found a case where someone was charged £254 to be allowed to keep their dog in what they believe to be their own house.
Yeah, no, I've seen that. I was recently helping somebody house hunt, and that exact thing came up. The person had pets, and this was to buy a property. Again, it was a kind of a sort of small house rather than a flat, and you weren't allowed to own a pet in the terms of the lease. But then there's also things like not being able to hang your washing out in certain parts of especially with flats. I mean, I get that there's a sort of old-fashioned thing about having, jumpers hanging on your balcony and it looks a bit, scruffy or whatever. But some of these restrictions, charming. Yeah, exactly. It's you're right. It's just unbelievable.
Well, the one that I'm interested in at the moment, in terms of, does a tenant have more power than a leaseholder? Is it one of the things that Labour has been talking about? Is saying that under rental reform, landlords won't be able to prevent tenants making alterations to the interiors of houses. I don't know about the exteriors, but, of course, leaseholders can't. Can't move walls around the place, can't build a conservatory, can't build a shed, can't do anything like that without going to the freeholder and asking. So, here's that really interesting shift in balance. Anyway, scandalous, remain scandalous. Things are getting better, will get better, but surely a much better thing to do, listen to me, governments, a much better thing to do would be simply to get rid of the whole thing and replace it with common hold, or, as John says, share of freehold, which works perfectly well. And why wouldn't it?
And obviously, if you're a buyer, just don't buy one of these things.
Just don't buy one. Literally, don't buy one. And whatever you do, don't buy one don't buy anything without really asking all these questions, because of course people don't know the questions to ask, do they? I mean, why would you think when you went to buy a new house that would not really belong to you? And then why would you think that there'd be this thing called ground rent that would go up and up and every year? And why would it ever occur to you that the person who owned the land underneath you was also the person taking a commission on your insurance premiums? I mean, for heaven's sake, you have to know the questions to ask, right? Why would you know to ask those? So, ask a lot of questions, but in the end, don't buy this stuff. Don't buy this stuff. And as ever, the way to change things is to put pressure on the providers to produce something different. Right, John, give me a personal finance tip for the week. Go on.
Well, actually,
a really good one.
This is one of your classic ones. It's people house builders are offloading those sticky last few houses on the plot that they need to get rid of, are now offering massive incentives. In fact, according to one of our Bloomberg colleagues, I think 1 in 5 houses now, up from 1 in 10 about a year ago, is coming with a freebie. And among those freebies occasionally is as much as a Tesla. Get a free car when you buy a house.
John?
Yes.
Do you want to rethink the word freebies?
No, it's a free car. I mean, look, what am I doing? I'm buying a house and, I'm getting like 40 grand's worth of Tesla thrown in. Okay. Surely, because the house builders are nice people.
Yeah, I don't like the house builders, so I don't believe that. Do you know what I think?
What do you think, Merryn?
I think you should say, no, thank you very much. I don't want a Tesla. I have a perfectly good car of my own already. What I would like is for you to take 40 grand off the price of that crappy house. Thank you very much.
That's genius.
Yeah. Keep your Tesla. I'll take the discount.
True. It's true. Why would you ever buy a Tesla with a mortgage?
That's exactly it. What you're doing is buying a Tesla with a mortgage. I suppose some people do that. Now, look, this is not the first time this has happened, right? We predicted this. We said, you and I, in a podcast a while back, or possibly in a column or something, we said, you'll know that things are getting nasty for the house builders when they start to offer you a free car, because it happened. I was just checking. to see when it last happened to make sure that you and I weren't making stuff up, because we don't like to do that. And it is absolutely true that in 2008, the obvious year, several developers were giving away free co-os with houses. And it was also the case in the US, where I found a particular case in the Midwest, where if you bought one of their horrible houses, or maybe nice houses, I don't know, American houses often look much nicer than our houses, you got a free Toyota Prius. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week, my conversation with Jonathan Asante, fund manager at Chikara Investments. Jonathan started with Chikara Investments this year after taking a break from the industry in 2019. Before that, he worked at Stewart Investors for 15 years. Now, Chikara, if you've not heard of it, used to be called Coupland Cardiff until August of this year. I spoke to Jonathan a few days before the launch of his new fund, the Chikara Global Emerging Markets Opportunities Fund, which he is going to have hold 20 to 30 stocks in long-term growth opportunities, high-quality growth opportunities. He's going to manage that along with a team of 4 that he brought over with him from Stewart Investors. So, here is our conversation. Jonathan, thank you so much for joining us today.
Oh, thanks for asking me.
Now, you and I haven't talked for a long time because you've been out of the industry for a while. So I wonder if we can just start by talking about why you've come back.
Yeah,
What's brought you back into this rather grubby industry?
It's interesting for me personally because I love the job of analysing and looking at companies, and I love that aspect of it. I always enjoyed it. I think when you've worked where I'd worked before, you have to be quite careful about where you end up looking after clients' money. So I was looking certainly for a couple of years for a place where I thought that I could fit. And secondly, my old team became available, and I know these people. I've known these people for a long time, and that was really what enticed me back, because I thought we could do something really very good for our clients.
Okay, so it was finding somewhere where you felt that you could fit, and also you could bring your old team with you. So no need to get to know or train any new people, anything dull like that.
Yeah, we've been together for 15 years, some of us, and we know each other. We know our strengths and our weaknesses, and we just hit the ground running, which was very important. But also, I think that the place was very important. I think I prefer small groups of people to large institutional setups. And that's what we had in my last job, although we were inside a very large institutional setup. And so it had to be a place where you felt that you could preserve that, or I felt we could preserve that, and just, be given autonomy to invest.
Okay, so you and your team will work autonomously inside the structure of Chikara.
Yes, and Chikara is a very small company. And so that is what was very attractive to me. The owners, there's, 3 or 4 main owners. I sit a meter away from them. If we've got any issues, I go and ask. And we will become owners too. And I contrast that with a very large organization, which, is fine for other people. But for me, I find that sort of personal interaction a lot more meaningful.
Okay. Yeah. Well, let's talk then about what type of investing you and your team are going to bring to Chikara. I know a little bit about your history as an investor. What is it that makes what you and your team do slightly different to what other people do?
Yeah, well, I think the background is we've been fortunate enough to learn from people that are very good at it.
Yeah, from the greats.
And we were able to absorb that and evolve it in some small measure ourselves. And we have very strong beliefs about what we're doing. We're very long term. We're very focused on the evolution of hundreds of millions of people in the developing world, and them getting richer. It's something you don't hear about, them getting access to more opportunities, and that's still happening and probably will happen in the next 10 or 20 years. And then we're very focused on the sorts of companies that we will give our clients money to and our own money to in the long term. And there are a very small number of companies that we feel comfortable in that area giving our clients money to. So I think the difference is this very small number of companies and the fact and the beliefs that we have about investing.
Yeah, I want to talk a lot about those companies, but let's talk briefly first about the emerging markets background. You say we don't talk enough about how much richer people are getting in this huge variety of countries. Actually, people talk about emerging markets, so kind of amorphous blob, and of course there's absolutely nothing of the sort. So let's talk about a little bit about the background of that and why it is that emerging markets are so much more attractive to you than developed markets.
I think the distinction has broken down to some degree and between developed and emerging. So that may not be very helpful, but the last 12 years I've spent telling clients that the distinction was breaking down, because at the company level, some of the best emerging market companies are in the developed world and some of the best developed world companies. But guess what? They realize there's growth over there. So they've gone in So I think that distinction, emerging markets was a marketing idea penned by the investment industry. Often you find that those are not very good investment ideas. And what we tried to do was make them impose a sort of investment discipline that would kind of ensure that they could make acceptable returns for our clients. So I think that the distinction is breaking down, firstly. Secondly, though, emerging markets had a pretty mediocre decade. And we've written a paper on why we think that is. We think it was a governance failure. And we think that the emerging market index, was never built for investors. It's built as a unit of measurement. But
sorry, when you say governance failure, what do you mean?
We noticed back in really 2010, 11, that at the top level, the leaderships were changing. So the emerging market pitch, if you like, was in the 80s, as I said, penned by the funds management industry, was that essentially governance improves in some of these countries after the Second World War.
And when you say governance, are you referring to political governance or to corporate governance?
It's a good question. I think the first leads to the second. So there's an improvement in governance after the Second World War, the end of communism, the end of apartheid, the Deng Xiaoping reforms in China, and you get better growth. And so there's an opportunity all of a sudden. You get better governance, so there's more companies that might actually through which you might be able to access that opportunity. And that improvement means that you should buy equities because equities are growth. That was the idea behind it. That was the marketing pitch, if you like. There's a number of problems with that. Firstly, history doesn't go in 5-year fund management bonus cycles. It seems to operate in centuries and millennia. And so you've got countries that were very interested in history that are re-emerging actually in many cases from having been very dominant countries 1,000 years ago. And those processes are a lot slower than the average fund manager would like. And they're cyclical. They don't go in a straight line. And the second, as I said, in 2010 was that we noticed that governance was going backwards at the top level. So you had changes of leadership in places like Turkey and South Africa, for a few, and then ultimately in China, where you had to question whether the rights of shareholders were going to be more or less undermined going forward in the next 10 years. So we had a problem that far back with it. And what that meant at the company level is that the companies that we would find to be acceptable, there were fewer of them. The other beauty of emerging markets was that if you had this governance improvement, there would be more and more companies to invest in that would be listing. You'd have a very dynamic sort of positive. But if the governance at the top level is deteriorating, then the companies available become fewer and fewer for us. So we had to do a number of things about that. Told everybody. We started looking more globally for businesses because the world is merging anyway. So you might have the governance and the brands in a global company that has been in developing economies for decades. And we found them in all over the place, actually. And we closed our funds as well. So in 2013, we put a front-end load on our pool funds, which were very popular, and we started to give the money back.
I wrote about it.
And part of that was the opportunities are getting less. If the opportunities are more, I'd love to run more money for you, but we're not going to go down the quality scale in terms of companies we're going to buy. And the opportunity, we think that the governance is getting worse. So I think that's been the problem for the last 10 years.
I mean, it's an interesting one, isn't it? Because the industry had to learn, again, that GDP growth doesn't automatically transfer into an equity bull market. And I'm still reading, even now, after I don't know how many cycles of this, I'm still reading papers that tell me, but because there's economic growth in a country, there will be a stock market boom in said country. And it's simply not true because of governance issues, because of valuation issues, all these things that we've been discussing.
Yeah, the pie gets bigger, but who benefits?
Yeah.
So if you're not going to be one of the people that benefits or your clients are going to benefit, it doesn't matter how big the pie is.
Yeah.
Some societies are set up for reasons of history to benefit a very small number of people. In fact, arguably the reason countries are poor, and I've spent my whole life, having grown up in Ghana in the 70s, I've spent my whole life wondering about this. The whole reason these countries are poor after the Second World War is because a small group of people decided not to share opportunity with the rest. It's sufficient opportunity, right? You give opportunity, then the economy grows bigger. If you give access to education, access to the jobs market, access to healthcare, then guess what? You're going to have more people that are viable and are productive. So I think that the emerging markets, although the initial marketing pitch was that things are getting better and they appeared to be, actually it was a failure post-World War II and post the colonial sort of the era that led to that opportunity. So the pie can be as big as you like, but you may not have access to it in many of these countries. And that's why we spend so much time thinking about who we're giving our money to in these countries. And
do you feel, part of you coming back to the market now, do you feel that there's an improvement in governance across the board that can now open up opportunities for funds like yours?
I feel like the deterioration has stopped, so that's something. And there are a very small number of companies where I think we can make acceptable returns for ourselves and our clients. I won't go further than that. I'm not, I said I was fashioned in Scottish fund management. I'm not a person we're not the people that go out there and bang this drum. I think for me, I can put my own money into it now because there's acceptable, and I don't have to look as much globally for businesses. So I think there's an acceptable set of returns that can be made in the next decade with not too much improvement. We try not to make investment decisions for clients and ourselves on the basis that politicians are going to act in the interests of the whole. We try not to do that because we haven't seen that for decades anywhere, actually, almost anywhere. So we try not to do that. But just with the deterioration stopping, for example, a few years ago, you had the head of Samsung and the leader of Samsung going to prison. That is an improvement. You've had the replacement of leadership in South Africa. You've had a leader in India who is able to galvanize certain aspects of that society so that the opportunity that was always present in India might be realized, although there's always risk. So there are some improvements going on, and there are some that are standing still. I think people have the idea that an authoritarian regime will allow you to make very good returns over the long term in an index of equities. I think that's been put to bed again in many countries. I remember going to Ukraine 15 years ago, and it was a huge country, huge resource and opportunity, but there was no governance at all. And, places like Russia have shown that time and time again that it doesn't matter that if the governance is bad. And authoritarian regimes tend to act in their own interest even more than democratic politicians because the downsides for them are greater, arguably. So I think there's recognition of those things, which is great because that's something that didn't exist 5 years ago. There was too much optimism about authoritarianism, and there are even some apologists for it. Now, it's not that I'm criticizing those regimes per se. They have their own history. They have their own path that they've taken. I fortunately have to ask a much more narrow question, easier question to answer, which is how will I benefit from my clients? Yeah. So it's a much simpler question to answer than sort of judging
and analyzing the whole
thing. A
thing.
westernized subjective view on a history that's thousands of years old. It's more how will I benefit in the next 10 years?
And what happens to the companies? Before we start talking about the types of companies that you look for, because I think that's probably the most interesting bit, let's just zoom out a little to the global economy, because this is a pretty brave time to be coming back into the market, to look at the global markets and the global economic environment, the global geopolitical environment in January and say, you know what, I'm going to dive right back into this now. Probably what is one of the biggest inflection points that markets and economies have seen in our lifetimes, right? It's with the inflation environment, the interest rate environment, deglobalization, all these things that we talk about constantly on this podcast.
Right.
The next 10 years, they look tough.
Yeah, there's a number of things. Firstly, our approach to investing means that we always do better when things are tough for clients. So I always say to clients, our business was built off of misery. So the first was the tech bust in 2000, where Angus was, as far as I understood, was the only fund manager that didn't lose significant amounts of client capital.
Angus Tulloch, by the way, for listeners not familiar with the history here.
Yeah, sorry about that. And the global financial crisis, where we once again showed that we lost capital, but far less than everybody else. So bad times aren't necessarily, the way that we approach investment, aren't necessarily bad times for us. They're times to, not prove that the good companies, and good companies do better in tough times because they tend to have not been near bankruptcy and they have more capital to expand. They tend to have a mindset where they understand that. The second thing to say is that you talk about all of these problems, they're global problems, but we're emerging market people. So we see a crisis every other year somewhere, right? So for us, this is quite normalized. Inflation going from 0 to 20%. For us, it's not a difficult. The finding says, we've been very skeptical about the global policy framework, monetary policy framework for decades. And I think it started with LTCM. Personally, where they bailed out the hedge fund and gave the message to everybody that you can take the gloves off, you can take as much risk as you like, and we're going to underwrite credit. So we've been expecting inflation for quite a long time, as if to prove that we're not our forecasts, we're not good timers of forecasts. So a lot of the companies that we invest in, because they are in volatile environments anyway, tend to be ones that should do okay in a high inflation or a higher inflation, low growth environment. You see all these consumer staples companies moaning about about the cost of living, all this stuff. That's fine, but they are the cost of living, right? So, you do sometimes wonder whether they are whether they mean what they say. They quite like inflation. I remember a company we used to invest in for many years in South Africa, and South Africa always had inflation about 4 or 5%. And I remember meeting the gentleman that ran it. It was a consumer staples company. He just looked at me and said, "Inflation makes us look like geniuses." So, I don't have to do anything. I just put my prices up 5%, and my cost base is relatively fixed. They've got a bunch of warehouses, and so those sorts of companies should do better. Some of the other tailwinds around global growth have been questionable as well for years. I mean, the West is hugely indebted, both at the government level and at the private sector level, and essentially is creating inflation, I would argue, to remove debt or to reduce debt. So those have been present for, I'd say, at least 15 years, those issues.
So you've been expecting the environment that we're in now for a while, and you'd expect this relatively high inflation dynamic across the West to continue?
It's a normalized situation for me. If I think about the themes and macroeconomics, you want to call it, I would have thought inflation would have reared its head earlier. They just had a huge tailwind from the gains from trade and from technology. So I think this is a normal situation, I think. It's just that some of those chickens have come home to roost.
Well, it's normal, but we're not used to it.
Politicians aren't. And populations aren't. But in emerging economies, it's a slightly different story. I mean, populations are used to the idea that a bank will go bust and take all your money. For example, they're used to this, right? Yeah. Because they've seen it within living memory. It's wiped out middle classes across Latin America and also in Africa. So they're used to the idea that there's a predatory elite. When you look at Transparency International's work on corruption perceptions, these are normalized expectations, and they're used to a very volatile operating environment. So I think it's, again, just coming from our corner of the world, or many billion people in the world, I don't think it's necessarily something that's unusual for us. It's more unusual in the West, perhaps, in the last 20 years.
So you're more equipped. Okay, well, let's talk then about the types of companies that you're looking for. You said there's a very small number of these companies. What are they like?
We tried to describe it with 3 words, which is who, what, and how. Who is who you're giving your money to. So we look at the history of often families, sometimes managers of people that we giving our money to. And some of these histories go back hundreds of years, which is remarkable. And we try to weigh up evidence of wrongdoing and evidence of stewardship. And we try to take a view on who are we going to give our money to.
So you're looking at the long-term history of the company on the basis that creates the current culture of the company.
For a number of reasons. We're often investing with families. Families have done something bad to minority shareholders or other stakeholders in the society 20 or 30 years ago. They can do it again quite easily under stress. And the biggest issue in emerging markets is having to sell after your share price falls. And if you have a low quality, what we call a low quality company, and the share price falls 50% and something terrible's happened, you have to sell and destroy your client's capital. Whereas if you have a very good company you have confidence in which you have confidence, you can buy more and you can be happy. We can't forecast the future, but it's this having to sell emerging markets when it's already lost you a lot of money. We would hope that most of our companies as we were in 2009, we were very happy. It was because we knew that we could buy more and we had a good chance of making acceptable returns. So we're going to make fewer of those mistakes. But the who is most important for that. It's really interesting work because, as I said, we're going back into history and we're looking at all kinds of information that the financial markets tends to often ignore, I suspect.
Can you give us an example?
If you look at the Tata Group, for example, in India, if you really want to think about why that company operates as best it can, and there's no such thing as a perfect company, of course, in as ethical a way as it can, you actually have to go back to the Zoroastrian religion, which goes back thousands of years. The Magi in the Nativity story were Zoroastrian priests, and there's a metaphor there about handing over a religious idea of looking after people, looking after others in that story. So if you really want to go back, you can go back all that way, and then you can see how that plays out today. Now, that doesn't mean that the company doesn't make mistakes, but behind it, what you have is a confidence in that group that if the wrongdoing happens, that it will be addressed, or that if fundamentally it's built on an ethical system that's trying to take advantage of a huge growth environment in India, but not in a way that is undesirable from a legal point of view, from an ethical point of view. So something goes wrong in a company and it falls 50%. If you have that knowledge, you're more likely to be able to buy that company. So that's the most obvious. But there are many groups with long histories. And sometimes I was looking at a Brazilian company the other day, which goes back to 1960s, for example. And that's a fair amount of it. It's not thousands of years, but that's when the company was founded.
Enough to get a sense of the culture.
And the same families are running it now, and it's decisions that they made. Brazil's a pretty dirty pond, as was exposed by the Petrobras scandal. And so if you're owning a share in a company which could be exposed for, let's say, corruption and bribery and fall 70% as a result within a week, you want to be pretty sure that the company you own is not one of those. So that means there's a very small number of companies that you can be sure or you can have a high degree of confidence that that's not the case.
And will that Brazilian company make it into the portfolio?
It will. It became rather popular. We owned it for a decade. It became rather popular, but it's becoming less popular now, which is why I'm not giving you the name.
I know, but we're gearing up to try to make you tell me.
But it became very popular, and it's becoming less popular.
Okay,
and that is,
listeners, guesses on a postcard, please. Okay, so that's the who, and then there's the what.
The what? So the what is the franchise good enough to make acceptable returns for its owners? And how do we think about that? We think about that in terms of pricing power. So if you're in an environment where inflation goes from 0 to 20%, you better have pricing power, because if you don't, you don't have any profit left. So I remember being in Ghana, talking to the woman that ran Unilever there. They actually have a listed subsidiary in Ghana, tiny. And Ghanaian inflation, as it often does, had gone through the roof. And I remember sitting there and she telling me that her most difficult decision was when to raise prices for their products. It wasn't if, it was when and how, because she was keenly aware that, this was going to hurt the pockets of the poor and how you can do that. But what that showed me was partly about the ethical side of Unilever, but also that they had pricing power. They can do it. Imagine if you can't, if you're a commodity where whether your inputs go up 50% or 20%. So this idea of pricing power, I think, is important. And that tends to take us towards consumer staples types companies with brands and some industrial companies with intellectual property and trust. The other side of it is, how did they get the license to operate in the first place, which overlaps with the who. Sometimes if there's an original sin there, it can come back to bite you quite badly in emerging markets.
What do you mean by original sin?
If the business was given by license by a government or a dictatorship to a company, when the regime changes, you can find your supposedly strong franchise disappearing into the dust.
Seconds.
Yeah. So I think that's part of the what is that, and we try to stay as far away from government as we can. Although, let's face it, in any economy, the government can interfere with you in any way it likes. But we try to stay as far away from those sorts of licenses, having made those mistakes over the years in the past. So that's another part of the what, really, that's quite important. The final part is what is now called ESG, but it's more, we just think of it in terms of tailwinds and headwinds. Have the management positioned the business to benefit from things that might go right in the next 10 years? And not suffer from things that headwinds that might go wrong in the next 10 years, such as governments deciding to price environmental externalities in a way that they should, in a way that would, and would that remove profit? I can give you an example. We used to have an organization we're talking 15 years ago, look at the carbon footprint of businesses. That's very, maybe more fashionable now. But the point was that there were some businesses, often related to the oil and gas industry, whereas if they had to pay even a sort of half decent price for the carbon emitted, they wouldn't make any profit. So again, your license to operate depends on governments, and it depends on deals done, in places that I will never visit, allowing that not to happen or it to happen gradually.
But you say that's ESG, but that's just G, isn't it?
It's just
environmental social governance. That's only the governance bit.
The idea is that good stewards of our clients' money they'll get things wrong and they'll get things right, but they will look at these issues and they should be better at it than we should in their businesses. And they should be looking long-term at these issues and trying to address them before they become fatal. And the idea that a fund manager turns up, and this has happened to me many times, and then tells the management of a company what's good for that company. How on earth would you own shares in a company where you have to tell them, you haven't spotted these 5 risks? So if you believe that about the company you're investing in, there's something wrong with that company. And we can engage with the company, but if they really haven't, then you probably, on the long term, shouldn't give your clients money to that company. So we want people that will navigate all the uncertainty for us.
Okay, so when other fund managers talk about ESG, for example, they talk about divesting or about having very clear divestment rules, areas they won't invest in, types of companies they won't invest in. Yeah. They have lots of box ticking, red lines around all sorts of things, and a constant conflict to my mind, to lots of other people's minds, between the E and the S and the G in the overlay that they give themselves. But it sounds to me like you don't really have any of those red lines or box ticks. You just have a general sense of wanting to invest in companies that provide good long-term stewardship. And that definition is fairly, can have grey areas in it.
I think it overlaps with ESG, but we can step back from the finance industry. I was trained in economics, and we all a lot of people in finance are trained in mathematics and statistics and economics, and they like right answers. So price and quantity is determined by supply and demand. There's a right answer. So, but the world is much more grey than that. And people that often do quite well in what we do are trained as lawyers or historians, and they're weighing up probabilities. So here's 5 pieces of evidence for and 2 pieces against, and the balance of probability. And if you're trained in finance, that's completely alien to you, this way of thinking. But this is the way that we have approached investing. So the ESG, in a way, is adding to the list of points for. It's more like being a detective in a way as well, if we think it's credible. And that is some of the worst companies in emerging markets. I was looking at one yesterday, so which I won't mention. They've got the best greenwashing efforts you've ever seen in your life.
You've got to mention some names for us. We like names.
Actually, I wouldn't dare. But they've got some of the best greenwashing efforts now. You know, for example, we spotted many years ago who are the oil companies in the sustainability indices. Right? So it's, we don't know what to say about that, but it's definitely.
Well, I remember after the war in Ukraine began that we found that there were some Russian oil companies that were very high up the sustainability indices. Well, this is mad.
Yeah, I remember having a meeting with one many years ago, and and I'll never forget it because we asked them about global warming. This would have been like 2006. And he said, actually, it's good because our Siberian permafrost will become farmland. That's as far as they got then. They actually wanted global warming to happen and change the climate. So
probably very fertile farmland up there. Right?
Yes. Yeah, well, this is as far as they got. So I'm sure that their efforts in sort of, have moved further on, or at least they think they have to present it. But back then, they didn't even have to pretend to give a damn. So it doesn't surprise me in that. So I think it has this ESG aspect to it, but we tend to sort of weigh up pros and cons because there's no such thing as a perfect company. And there are areas that we find very difficult to invest in. They've always been tobacco. It's called defense, but I think that I prefer to call it the attack industry. And we found that difficult, especially, and we actually don't have many opportunities to do it.
It's hard to argue that it's not a social good. In some ways, I mean, defense, I can see that a lot of fund managers have said historically, as you say, defense/attack. This is not something we want to be involved in.
Yes.
But in an environment such as this, it's very hard to say that's something that isn't required.
I can see the point, absolutely. And it's one of these, it gets grayer. Actually, the next one is going to be
It's a very grey one.
And we don't have many possibilities to do so.
And you said there's another even grayer area.
Yes,
What's that?
Which is an area that a lot of people ask me about now, is we found it very difficult. And again, we haven't had much chance to invest in them. We found it very difficult to invest over the years in luxury goods companies. And that's an even grayer area. And on the one hand, it's very aspirational and, people striving for material, to gain pleasure from material. On the other hand, we associate it, and we have some evidence that it's also linked to political economies where an elite is stealing capital flight.
Well, it comes back, as you said, to money not being shared.
And, ending up in London or Singapore. And it's interesting, the Singapore government, I think, is thinking about this now as well. And so what you're doing there is you're trying to weigh up a number of grey areas. One is quite a positive sort of striving. The other is actually there's a lot of capital flight involved in the developing world in some of these goods. And that's going against what we're trying to invest in.
Yeah.
The one thing is that, as an African, is that one of the main differences between Asia and Africa has been that the capital stayed in the country. It stayed in sight in the country in Asia. And in Africa, it flew out at the first opportunity.
First possible chance.
So capital flight's a really big issue in terms of those hundreds of millions of people getting richer. So that's one we struggle with, but it's one that I thought I'd raise because it's an even greater area.
But you don't need it, do you? You don't need luxury goods companies in your portfolio.
firstly, there aren't that many unless you look globally, and even those are not big emerging market businesses. And there were some that tried to list in Hong Kong, sort of as exits, I think, a few years ago. So it's not such a big issue, but it's something that we raised to show the grey areas that we try to navigate.
Can I ask you, have we done the where?
Who, what, how?
Where? How? Sorry, who, what, how?
How is now called ESG. It's how they're behaving. So if you've got a history of polluting rivers or using child labour or, illegal logging, and so basically, if you're prepared to do that to your own environment, your own people, what the hell are you going to do to your foreign minority minority shareholder at some point? We used to call it how, and I think that's partly the risk that ESG is trying to capture. As you say, some people would say imperfectly, but it's the risk it's trying to capture. The how, and it also tells us quite a lot about the who, how they behave. For us, who, what, how is very important in trying to really eliminate lots of companies. That becomes quite easy in GEM because, for example, a company that's run for the government.
GEM, Global Emerging Markets.
Global Emerging Markets, sorry. So in developing, so if you have there are very large companies run either owned by the government or run for the government. And I always ask people to perish the thought, but if the NHS was listed, would you ever invest in it? Because the more profit it made, the fewer lives it saved. And so there's this massive conflict there, right? So would you do this? No, right? You wouldn't, because it would be, you don't know, the government would be involved. You just don't know how that would work out. We've got a lot of those who's in GEM. And then we've got a lot of families who we can't get comfort with the history of how the assets have been acquired and whether that will come back to them at some point. And that's the classic case where you lose 60% and you have to sell. So we just can't, we find that really difficult.
Let's add a where to your list. Then.
Yes.
Which markets, which economies are interesting? I know that you don't do it like this, but nonetheless, I think our listeners will find it interesting to know which particular economies are working for you at the moment.
Can I reframe it? I can do slightly to answer your question, which is, where do we find the most companies that meet our criteria?
Yeah, that was a much better question.
So because we are so bottom-up focused, I can talk to you about macro, and we've tended to find more companies over the many years in India, and that's because there are so many companies listed in India. The proportions are still quite low, but it's just that there are just so many, and the stock market has been allowed to evolve in a sort of vibrant way. We would have hoped 20 years ago that Turkey would have gone the same way, but under different leadership, it hasn't. So that's a place where we find lots of companies. We can find a few in Latin America. We ran a Latin American fund in 2009 on the basis that there were a bunch of companies that had listed in 2004, 5, and 6 that had, some track records long track records that we could test. So I'd say that India is a place where we find the most companies that fit our criteria, but it's because it's a low proportion of a much larger number.
China?
China we've struggled with, and we struggled simply because of answering the who question, which often impacts the what. We have, in the past, we used to invest in Taiwanese listed companies, for example, businesses on the mainland, Hong Kong companies with businesses on the mainland that were going to mainland. But that I think is, with the way that the political environment in Hong Kong has evolved, I think that's slightly more difficult. So we've got a list of 4 or 5 companies that we think we can evidence are entrepreneurial, built far away from leadership and the government there. And that's out of a very large number. So it's a small number of companies that we can get comfort with. And yeah, we'll keep looking. I think China's a huge economy, which has a lot of dynamism in it. And we'll just keep looking. We struggle because at some point it always kicks back to the leadership, and you always go back to the political economy there. And do you really own equity, or is it decided by some opaque sort of mechanism? But I would never want to rule out. The thing that gives me more hope is that these issues are now widely recognized, whereas 5 years ago they weren't, and they're widely talked about. And it's an evolution of history, really, how the West responds to the rise of a different viewpoint is more widely understood.
Yeah. Do you have a set valuation criteria?
I've got my own money in the fund, so I need to earn, and that's assuming inflation does come down again to some reasonable level, is not allowed to run off globally. And I need to earn 10% in nominal terms, around 10%. 9 would be fine, to compound that over 10 years, to reward me for all the terrible risk that I'm taking all the risks I'm taking in emerging markets. And that's something I've been saying to clients for a long time. That was one of the reasons why 10 years ago we had to look more globally. And I think that is more achievable now. It's not a forecast because things can happen, but those are the sorts of returns that I need to own the best quality companies.
And this is more achievable now because emerging markets are, historically speaking, relatively cheap.
They're relatively unpopular. And there's still some very expensive, some good quality companies that we'd love to own are still too expensively valued.
And what do you mean by too expensive?
the returns that I can earn for them are below the 8% threshold.
Based on the valuation.
The problem with valuation is just using a straight P number.
Yeah. So you always know what I'm trying to get you to say.
Just using a straight ignores the idea of, firstly, the return you want to earn and the growth that you think the company's going to. We're not people that are wildly optimistic about growth. So I prefer to talk in terms of return, because a P of 5 for, I don't know what the P of some of the worst state-owned companies in GEM are, but they're very cheap. And they're cheap because ultimately you have to ask the question whether you actually own anything by owning them. So I think a sort of very sort of valuation-focused approach in GEM can work for 2 or 3 years. No doubt does when people get really sort of bullish, but the long term has been proven not to work. And that's because of the governance. Do you own the thing or not? Or is it being run for something completely different? So that's why I prefer to talk in terms of returns. A low PE tends to indicate that you can make higher returns, but then if the business is going to shrink for the next 10 years, then you're not.
Value traps.
Yes, absolutely. And GEM has got, I would argue, lots of those. And I'm not here to say that I'm optimistic about owning state-owned anything in GEM. They can have a good 2 or 3 years, but we're trying to make 10-year decisions, and I'm not. It's just a decision we just can't make. So those sorts of returns we can find in companies that are going to grow 10 or 15% an annum for the next 10 years. We can find them in companies that are going to grow 5% per annum in the next 10 years, or where we could reasonably think that they will. But those are the sorts of returns we need, and they are present. Otherwise, I wouldn't be putting my money into the fund. Whether we end up earning 7% or 12%, that's fine. But we're in that right ballpark now.
Can you give us a couple of examples of the companies in your top 5?
Yeah, I'm trying to give ones because we're about to launch our fund.
I know. I understand that. So it's a really difficult time for me to be asking you to name names.
So we're about to
anything that's big enough that our conversation here can't move the price. It's got to be something big.
It has to be a very big company. I'll tell you about the last report I wrote. We write, our fund managers, we don't believe are analysts, so we do all our own work. We don't use the sell side is full of very bright people, but we think they're asking very short-term questions because they're encouraging people to buy and sell stock. So if a person buys and holds for 10 years, it doesn't make the sell side any money. So we do all our own research. The last company I wrote a report on, which we're going to discuss later this afternoon, is a Japanese company called Unicharm. We've owned it for many years, and it is it's one of the leading makers of diapers and sanitary napkins in the world. And the interesting thing about the company is about 40 years ago, when the Sun, 40 years ago, before the Sun took over, it realized that Japan was shrinking, and it started an expansion into emerging markets. That has often been a recipe for disaster for companies all over the world. Well, we've got to get some growth, but they did it very carefully. And they now have over 60% of their sales is outside Japan and mostly in emerging markets. Okay,
so this counts as one of the companies that is global but very exposed to emerging markets.
I use it for a number of reasons. Firstly, because it's a global company. Mm-hmm. Secondly, because it's big and liquid, but also it's the last report that I wrote. And we've met the founder, the owner many times. It's run by the owner. We love companies that are run by owners with a long-term view because they take different sorts of risks to somebody that's on a 3-year option program. So, for example, its balance sheet is ungeared. It has cash on its balance sheet, which a professional manager wouldn't do because on a 3-year view, especially with low interest rates, you buy back shares and increase EPS. But a real steward knows that the tough times come, and maybe a bit of cash would be good so that when the tough times are here, you can make some acquisitions or you can take market share. So that's the last company that I wrote on. It's a company that we've owned for years. There's some very interesting 2 or 3 companies in Latin America, for example, and GEM is one of the reasons GEM's failed is some of the even the very well stewarded companies fell on hard times and made mistakes. One of those companies is a company called Natura in Brazil, which we owned for many years and then had to sell because the founders had decided to go on a debt funded acquisition spree, which essentially has caused the company some problems in the last 10 years. They bought The Body Shop in the UK, which was an error. And they bought Avon, which may or may not be an error. So we engaged with the company and sold many years ago. We were very concerned about the company because of the debt profile until they did something a few months ago, which they had incubated a business called Aesop. We didn't realize the value in that business, so that's our mistake in many ways. But they just sold that to L'Oreal, which essentially removes all the debt that we thought they had. and that deal has been done. So what you now have is the same stewards who are chastened. There's been a change of...
Chastened, but with cash.
Who are no longer indebted and have a much bigger business. And the stock price is 60 or 70% lower than it was, off the top of my head, 10 years ago. They have brands, and they're one of the only B Corps in emerging markets for, if you like, ESG. But I think they were doing ESG before anybody even knew what it was. So it was just part of the DNA of the founders of the company, essentially. And so that's a very interesting company, because it's kind of the microcosm of part of the reason why emerging markets failed for 10 years, which is some of the really good companies made mistakes. And if you can find companies where those mistakes they realized, and clearly they didn't bet the ship because they had this business and they knew, then that might be quite an interesting company to own for the next 10 years. So that's another example. It's a different type of example.
Well, you gave us examples. Popular. Thank you.
Yes.
Now, listen, Jonathan, I have to ask you a question that you won't like. You won't like, but I have to ask everybody at the end of the podcast, and we're watching the answers very closely. So please be aware this is extremely important. Okay? I am going to let you buy one asset and one asset only for the next 10 years. And I'm going to give you a choice of 3, all of which you will hate, but one of which you must choose. Gold, Bitcoin, or cash in a deposit account in the UK?
I have to answer as I personally have. So apart from my own fund, I have cash in a deposit account in a government deposit account in the UK, earning me 5.5%. So it's my fund in that.
Okay, so you would take cash over gold over a 10-year period?
We were very...
Despite your belief that I share that there is a degree of financial repression underway.
I think if you'd have asked me 15 years ago, I would have said have a bit of gold. I just never, I've never felt comfortable with gold, and I think that there are now alternatives to it, and it hasn't truly done what we thought it would do 15 years ago.
All right. If I take cash out of the equation, this is a supplementary question that I shouldn't ask, but if I took cash out of the equation, would you choose gold or Bitcoin?
Oh, definitely gold. Yeah, absolutely. I find the rise of these alternative ways of storing and transacting wealth, I find them to be partly technologically driven, but also partly a symptom of the excessively loose monetary policy that we've had in the last, take your pick, 20 years.
20 years, 30 years, 40 years.
I don't blame, I can see what they are, and it's essentially an admission that the government is debasing your wealth. But I don't believe that they are stable sources of wealth, of capital preservation. I don't believe.
Okay, there we go, listeners. Gold it is. Well, actually, it's a deposit account, but secondary, it's gold. Jonathan, thank you so much for joining us today. That was really interesting.
Thank you, Merryn.
Thanks for listening to this week's Merryn Talks Money. We will be back next week. Catch our debrief on this week's conversation on the Merryn Talks Money after show in our normal feed. That is, I'm afraid, only accessible to Apple News subscribers and to Bloomberg subscribers. Look out for the after show online. It's quite good, actually. In the meantime, if you like our show, rate, review, and subscribe wherever you listen to podcasts, and do please also tell your friends to listen. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi, additional editing by Blake Maples. Special thanks to Jonathan Asante and John Stepek. Be sure to sign up to John's daily newsletter, Money Distilled. The link for that is in the show notes. And actually, that's quite good too.